The Fed restarted QT a couple weeks ago after pausing after the Silicon Valley Bank implosion. So after Silicon Valley Bank had a run on its deposits, after making some very bad investments on long-term treasuries, the Fed paused QT and implemented some new lending programs for banks so that banks could get liquidity as they were faced with deposit withdrawals, which could have created a run on additional banks. So QT was paused, and then a new approximately $400 billion in additional loans went out to banks to provide them with liquidity to prevent this deposit run, the run on the banks. And you saw this massive spike in the Fed's balance sheet around the Silicon Valley Bank implosion. We've since started to reverse the $400 billion. We're still out there with $250, $300 billion. We'll find out exactly where we sit tonight. But so that is starting to get unwound. And QT restarted 2 weeks ago. So we are beginning to see the bank's balance sheet as made up of bonds start to go down again. It actually did not go up during the Silicon Valley Bank crisis. It just ended up going on pause, but has since been resumed. The Fed has indicated that they will continue their quantitative tightening policy. In my opinion, this is one of the biggest reasons we have inflation. So to fight inflation, this needs to continue. The other possibility here that is getting not enough attention is this is going to create a credit crunch in the economy. These deposit runs, even though they've been offset with some of this lending by the Fed, is going to tighten lending standards, make it more difficult for companies to get loans for expansion, new plants, buy real estate. It's even spilling over into the auto loan sector already. And we've already seen a massive increase in mortgage rates over the past year. So the credit crunch is at its beginning and is going to, in my opinion, push what was a probable recession into a very, very likely recession. The chances of us avoiding a recession here look pretty slim, in my opinion. So the credit crunch is upon us. That means that the economy is going to slow. Revenue and earnings are going to begin to slow here, and the stock market doesn't seem to have that priced in. Continue to watch the Fed. If QT continues and they continue to raise rates, it does look like they're going to do at least another 25 basis points here at their next meeting. So that is going to continue to be a headwind for stocks. So in my opinion, I'm staying cautious with my stock allocations, and I think that we still have some time to run as far as the recession and the economic impact that we're going to see across the board from Fed tightening, credit crunch, slowing economy. So that's my opinion. That's what I'm doing with my own portfolio. Please remember, this is not investment advice. This is strictly what I'm doing with my own portfolio. Please take a look at our full disclaimer at buildingbenjamins.com, where you can also sign up for free email and text alerts. Thank you very much. Have a great day.